Hello, hello, hello. You know I gotta play my intro music. Messed up. What is the official first episode of the Lawron Ballard Show? I know if you've been seeing me here on LinkedIn or YouTube or on TikTok, I've been doing this for the past couple weeks, but this is officially the first episode, and so excited to be here with you all once again. Happy Wednesday. It is a hot one here in Philadelphia. And as you can see, I'm in short sleeves. Forgive me for the noise. I have a dehumidifier running here in the studio because it is hot, y'all. It is hot. But what's also hot is this news. So let's jump into it. So first thing that you should know, this came out January 29th. Excuse me, not January, June 29th. So just a couple days ago, ahead of the 4th of July holiday, that the Trump accounts that were created as a part of the One Big Beautiful Bill, they have now confirmed that any contributions made to that Trump account will not be viewed as a gift. A lot of people were concerned about making contributions to that account because they thought that they might have to keep in mind gift tax requirements. But it turns out the IRS just released guidance that said that you would be exempted. Also, if you had a child in 2025 or are expecting a child between now and 2028, you are eligible to claim the $1,000 in the year of birth for your little one to be added to your Trump account. Completely unrelated to tax, I just had to touch on this. Did anybody see that somebody climbed the Empire State Building? Actually, it was two people, a man and a woman, and they got engaged today. That happened today in New York City, which was very, very crazy. It is burning up. They said that the temperature at the time of the ascent was about 89 degrees and the wind gust was 5 to 10 miles an hour. So the fact that they were willing to brave climbing the Empire State Building and in this heat, kudos to them. I know the NYPD was not particularly happy about that, but they did make it up there and wave their flag and got engaged. Last in news, there is an appeal. There are currently people who are feeling like business owners need to pay a bit more in tax. We hear this same song and dance all the time, but this is specifically for business owners who are using pass-through entities. So that can be LLCs, that can be partnerships. The article from the Center for American Progress says business income has moved beyond corporations and tax policy must follow. So when partnerships were first introduced since the 1980s, partnerships have displaced traditional C corporations as the largest source of business income and ultimately transforming how business taxation works in this country. So a lot of small business owners that I know have an LLC or they are in a partnership. A lot of real estate investors I know are in partnerships. And so, yeah, all of that income gets transferred, gets passed through directly to the owner. And depending on how you structure your tax planning, may not get taxed at all. So interesting that people want to tax that. It's always a matter of time before they create some type of tax. And honestly, this already exists in certain states. So California is a state like that. New York is another one where they insert minimum taxes regardless of your filing status so that they can get their hands on a little bit of that income, even though they are passed through. So we'll keep an eye on that. I know that this is just a thought piece, but I anticipate that there will be some type of restructuring that may take place so that people can be taxed as partnerships as well. So as always, before we jump into the content, I love to share a couple case studies of what the benefit of tax planning is. What are the benefits of tax planning? So I have two case studies for you today. The first one is an accountant. I picked that one because I am an accountant. I love being an accountant. And so always love when I get to the opportunity to shout out accountants. And so in this one, they had total annual revenue of $900,000. And that came from W-2 income. So how in the world, and this is one of the common things that I hear from people, how can I avoid taxes if I don't have a business? If I am a W-2 employee, what can I do? It was 4 strategies that they were able to use to get their tax bill to zero. Their original tax bill was $209,000, just shy of $210,000. And they used 4 strategies to completely wipe out their federal tax bill. So the first strategy was equipment leasing. So what is equipment leasing? We've spoken about this before, but with equipment leasing, you essentially create a company that leases heavy equipment, and in exchange for the equipment that you rent, you're able to take some losses and some offsets. That is considered active income as long as you meet specific requirements. And in doing so, you are able to take that against your W-2 income. The second one, oil and gas. This is another great opportunity for my high income earners who are W-2 only. Oil and gas, because of the way it's structured, normally allows you to take some type of offset for that income and take it against your W-2 income. Forgive me, I had a little bit of a distraction there, so forgive that pause there. Then this client set up a family management company. So what is a family management company? A family management company is very simple. It's essentially a separate entity. We were just talking about partnerships. A family management company is usually some type of partnership that you are able to create to help your family manage the business endeavors that you have. That can be real estate. That can be equipment leasing. That can be another business venture. It could be an active business. So if this accountant was not W-2, but they were actually a practice owner, it would be you could use the family management company to essentially have oversight of all those businesses. And through the family management company, you are able to pay children. This client indeed had children, so they were able to pay their children through that. They're able to pay for board meetings and travel. There's some very specific things, and you want to make sure that that's tight. Always work with a tax preparer or a CPA to help you determine if this is a good solution for you. But they were able to take advantage of this. And then the last thing they did was charitable financing. When I talk about the nice thing about charitable financing is that you usually get more than what you contribute, but I don't necessarily think that is always the best option for folks. There's a couple ways that it can be done. Depending on the age of the taxpayer, it may not be the best solution, but there are other opportunities for you to increase how much you can take in terms of a deduction from a donation perspective. So charitable financing is what this client did, but that's not for everyone. That's case study number 1. Case study number 2, this is a real estate investor. They were single. They had W-2 income. They were a business owner. They had some real estate income, and they had some investments from passive investments. They are not married, and they do not have any children. They only used 3 strategies, and they were able to lower their tax bill by 78%, which again is a huge amount of savings. That equated to total savings between the Fed and the state of $88,000. These folks are saving literally salaries worth of income in terms of taxes just from being proactive. And so I want people to hear that, because if you had an extra and I know that we're using numbers that may not be for everybody, but if we were able to save you an extra $20,000, $30,000, $40,000 in terms of taxes, where could you use that money to better improve your life, add value to your community? This is why tax planning is so important. It's not just to save money and to talk about how much we've saved clients. It is really so that you are in control of your financial situation. And we just get the opportunity to take that money from one bucket that it was going to go somewhere and you have no control over it, and put it into your bucket and make the best for yourself and for your future. So with this client, it was three strategies: accountable plan, essentially an opportunity for you to pay yourself back for business expenses, and is you will get a reimbursement from the business, and it is no income to you. Second one is an Augusta rule. So they own their own home and they rented out their home to themselves and were able to take the deduction. And then the last one, again, was equipment leasing. Really nice, quick and easy couple case studies here. And so if you or anyone you know is looking for support figuring out what is your tax strategy for 2026, please do not hesitate to reach out. You can reach out to me here on TikTok, send me a DM. If you're watching live on YouTube or LinkedIn, you can also leave a comment and I will absolutely get in touch with you. As always, if you have questions that you want us to answer during the live show, please do so by sending them to questions@hilltownadvisors.com. questions@hilltownadvisors.com. We would love to make sure those questions get answered in real time. Now, I want to move into our content for today. And a lot of times when I am working with clients, one of the first things they say is that, I feel like I overpaid last year. I think things are okay, but I'm not 100% sure. And we always have to start the process with getting clarity. And so today I am going to walk you through the 3 B's of assessing your tax situation, because before we can figure out where you are going, we've got to first start with where you are moving from and your current position. And so I call this the 3 B's. The first B is what I walk every single client through, and that is what I call building a baseline. So think about it like this: when you are working on your fitness and you say, I want to lose 30, 50, 100 pounds, whatever that number is, you are actively looking to lose weight. When you go to the personal trainer, or when you go to your physician and you're telling them that, I want to start a workout plan and all this other stuff, we start with the baseline. They're going to take your weight. They're going to take some measurements if you go to a personal trainer, because they want to understand where you start. Because if we don't understand that, then we don't know if we're making progress or not. Similarly, when I'm working with a client to help them save in regards to their taxes, we always build the baseline. And the baseline is essentially, where were you last year? The last tax return that you filed, where were you at? We want to take a look at that, deep dive into that, and make sure that we have clarity on that piece. And then once we have the baseline, then we have to start layering on what is going to happen next. And so when going back to that that personal trainer example, once your trainer gets your baseline, then they're going to do something to essentially help you calculate your macros. So we got the baseline. We've got to then take that information and come up with a plan. So from my perspective, when I'm working with clients, we then go from the baseline, where you started last year, the last filed tax return, and then we blend on the changes that may take place in the current year. The last step to determining that baseline is benchmarking your starting taxes. And when I say your starting taxes, I'm saying your baseline plus your blended changes for the year, blended more income, more deductions, a new child, whatever has taken place in your life, we've got to add that on. And once we have that, then we have a benchmark for where our starting taxes are. Why is that important? Because this is the very first step in another framework that I call the 4 A's. We've got to assess, we've got to understand where are we starting from. And without understanding that, then we are not able to move forward. And so this is just a very simple lesson, because I want you guys to understand that tax planning doesn't have to be something that's high flown or anything. It is just simply assessing where you are starting and then making adjustments accordingly. So now I want to get into some questions. If there are any questions on TikTok, please drop them in the comments. I'm looking really quickly. I know I haven't been focused on you guys, so I apologize, but I'm looking really quickly to see if there was anything that came through. Any questions? All right, so if there are no questions from the live audience, let's go with the 5 questions that I have prepared for you. So question number 1. Sorry about that. How can I legally reduce my taxes? So this is one of the most common questions that I get. And honestly, I hate saying this, but it's the truth. It depends. So I gave you the case study of the accountant and the real estate professional. There were some overlaps in terms of what they did, but there were differences, right? And so how you can legally reduce your taxes is going to be by taking into consideration your current situation. What do you have available in terms of capital or resources? If you have a business or not, all of those things come into play. And so if I were someone who was maybe making $100,000 a year at a W-2 job, I think the most common things that I would look at to lower my tax bill is giving to charity and contributions to a retirement account. Those are the lowest hanging fruit that I would use if I made $100,000 or less. If I was over $100,000 but under $500,000, again, assuming that I'm a W-2 employee, I may look at starting a business. That could be a short-term rental. That could be a side business that complements or uses your skills. And depending on whether or not you are married or single, you may actually have the opportunity to look at some other strategies where you invest money. There is an ROI and you're able to take advantage of that. Then beyond 500,000, that's going to be really dependent on how your income is structured. I might look at donor advised funds. I'm going to definitely look at opportunities that you have to invest capital in, depending on your level of comfort. That could be real estate, that could be oil and gas or mineral donations. I'm definitely going to be looking at charitable contributions. And I may also be looking at some type of energy credit if that is applicable. So I gave you a couple options depending on where you fit. How much should I set aside for taxes? I just got this question from a client the other day. And this, again, is dependent on how much you make as a family. So if you are married, then it's as a family, or it is, if you are unmarried, it is you by yourself. And so depending on how much you earn collectively or individually and how you earn that money is going to determine how much you should set aside for taxes. If you are $500,000 or over and you already have If you have a W-2 job and maybe you are getting some self-employment income, I kind of default to 40% to hold back and set aside for taxes, assuming you don't live in a high tax state like California or New York. Next question, should I form an LLC or an S Corp? That is going to be dependent on what you're trying to do. So if you are investing in real estate, I'd probably lean towards the LLC. If you are managing real estate, or I would lean towards the S Corp. So all of those things are going to be dependent on what you're trying to accomplish. But LLCs for a lot of folks are a good option. What expenses can I deduct? For ordinary, so the IRS tells us, the Internal Revenue Code tells us that from a business perspective, you are able to deduct expenses that are ordinary and necessary to run your business. That can be home office, that can be vehicle, that can be travel, that can be meals, technology, education. And we just got to make sure that it's documented properly. Finally, when should I start tax planning? Today. It is July 1st. You should start tax planning today. If you have not already started, you need to start now. I would say that July through November is the critical tax planning window. And if you do not have a plan in place, I highly recommend that you get one in place. Let's make sure there are no questions. I want to make sure that there are no questions. As always, if you have questions, please do email them to me at questions@hilltownadvisors.com. I always want to make sure that I am including audience questions in these broadcasts, because it makes it so much better when we do so. Well, this is it for the show today. I'm so glad that we have made it thus far. We've been doing the show for about a month, and really excited to continue to share some quality information with you in regards to taxes, business, and all the things. If you have any questions, please feel free to reach out to me. If you are looking for somebody who can do tax planning for you, proactive tax planning for you, please do not hesitate to reach out. Hilltown Advisors would love to be of support to you. And if you are in the Philadelphia area, please stay cool. It's going to be hot for the next several days. So stay hydrated, stay out of the way, and I will see you all next week. Oh, and have an amazing 4th of July. Until next week.